and thank you for coming along today. We've had a lot of requests from our clients to have an interview with you again.
No problem.
So to jump straight into it, what do you think the impact of the growth in debt around the world is having on the world?
It's a good question. Certainly things have changed in the last couple of years from the last paradigm that we're in. In that period from the 2008 to 2021 or 22, we're in quite a benign environment where growth was positive but small, and inflation was positive but small. And so in that environment, bonds and equities broadly did quite well in tandem. And things have changed obviously since then. We're now in a more inflationary world. And growth has started to slow down in the last year or so, but we did have a large period of growth from the kind of post-COVID period. So that was quite a new regime, I would say. Now, the situation in the US is that we do have quite a lot of debt at the moment. Particularly, there is a fiscal deficit, which means that the government is spending more than they bring in through tax receipts. In fact, the figure at the moment is around 7% of GDP, gross domestic product, is in deficit. So they're spending a lot more than they bring in. And what that's meant is that this year, where if you look at the US, for example, things have been much more robust and resilient in the economy than people expected, the debt portion has helped. So kind of conversely, what they've done is they've been spending lots of money to help prop up the economy. So there have been a variety of different policies, from the Inflation Reduction Act, called the IRA Act in the US. You've had the CHIPS Act, which is another act onshoring a lot of production from elsewhere into the US. And they've had other kind of fiscal measures, like, for example, they've had student loan forgiveness or allowing people to pause their student loan payments. So a variety of different policies amounting to about $1 trillion have $1 trillion in excess of what they usually spend, have helped keep the economy afloat. So it's been a good short-term boost to the economy, and that's why we think the US has been so resilient this year.
Yeah, you talk a lot about resilience, and we have seen it across this year. But are we going to continue in calmer times, or are we going to move back into boom and bust territory, or is it fiscal cycles again?
Yeah, we definitely in that period 2008 to kind of 2020 or so, we'd moved away from the boom and bust cycles. It was pretty much in a straight line, as I said earlier. It does look like now we're back to more of a traditional cycle where you have growth periods and slower periods, more volatility around growth and more volatility around inflation. That's true. The other side of the coin, however, is that governments are more involved now in policy setting, and taxes are higher, and there's more general involvement in our lives. So yes, we might find that actually a bit like 2023, perhaps growth was slowing, but they're happier to run a larger fiscal deficit to kind of offset some of that lower growth. So it does look like we will have more volatility around growth and inflation, but I don't think we're going to go back to a pure kind of boom-bust style cycle as we've seen historically.
So you bring up inflation there, and how do you think inflation will play through to our portfolios going forward?
Yeah, so inflation is on the way down, which is really positive. The long-term trend of inflation is now getting back towards levels that we're more used to. What we would say is that it's not, the last mile in terms of inflation is the hardest mile. So we're not ringing the bell or banging the drum and saying that all is well. We think that there is still some work to do. And central bankers, all the while that unemployment remains quite tight and all the while that wage growth remains too high, will be agitated, and that means they'll keep interest rates elevated. That said, we're moving in the right direction, and we think that interest rates have broadly peaked. If you take the US, the UK, Europe, the Eurozone, we think that rates have peaked. Interest rates have reached their final kind of hike. And broadly, when you reach that final hike, what that means is that bonds start to outperform things like cash, for example. So looking forward, the market's pricing in rate cuts for around mid-next year, mid-2024. That means that from around now to mid-2024, you should start to see some quite positive returns for bonds. And then as we really approach the final, that cut, you start to look at other assets, like, for example, smaller companies typically do quite well on cuts.
Yeah, absolutely. So you're going to be taking more tactical view of bond investments and looking at duration.
Yes, so at the moment we have some longer duration assets in the portfolio, i.e. those are bonds that have longer maturities, longer dated maturities. Those longer dated maturity bonds are quite sensitive to interest rate rises. So If interest rates are cut, they normally go up a lot. The prices go up a lot. If interest rate rises happen, i.e. they go up, bond prices start to fall. And so at the moment, we do have a very small bit of long-dated bond exposure. As we start to approach the rate cuts, we might start to add more long-dated exposure. And what we've done is we've done some analysis, and it looks at the asymmetry of bond returns. Bond yields at the moment are so high that there is an asymmetry of bond returns if you start to see cuts versus returns. So to put it into context, the 10-year US Treasury would rise around 11 or 12% if you get a 1 percentage point interest rate cut. If you get a 1 percentage point rise in interest rates, US Treasuries would only lose about 1 or 2%. The equivalent 10-year Treasury would only lose 1 or 2%. So you've got this kind of 11 to 1 upside downside skew of returns to the upside. And to us, we think that looks quite attractive. We like investing when you get that asymmetry. We like investing when the odds are stacked in one side versus the other side. It doesn't mean that it's risk-free. It doesn't mean that you're only going to make money always, but it just means that we have an imbalance in terms of upside downside returns, and we really like investing with that kind of return profile.
Well, it certainly sounds good to me. I'd much prefer a more positive upside than a downside.
Exactly.
So moving away from bonds, which we all understand, can you provide some comments around crypto and whether you see it as an investment now or not?
Yeah, cryptocurrencies had a much better year this year than it did in 22. What we would say about crypto is that there are clearly risks around investing into something like that. And, it's got regulatory risk, but also a lot of the reasons why people owned it was as an inflation hedge and as a store of value. Now the problem is from our perspective, if something can fall 70 or 80%, it doesn't represent a very good store of value, and it did that, by the way, in a very big period of inflation. So it's also not a very good inflationary hedge. So to our mind, we'd probably avoid it. It's very hard to value those assets. They could be stolen, they could be hacked. A regulator could come in and outlaw it. But fundamentally, it doesn't have cash flows. We like to invest into assets that have earnings attached to them. We like to invest into things that provide dividends. We can value a company based upon the earnings and the expected cash flows. Unfortunately, cryptos don't have cash flows, so we can't fundamentally value it. So if you want an asset that might provide long-term long-term inflationary protection or long-term kind of protection against the debasement of currencies, we'd probably rather invest via things like gold. Gold has shown that it's got a store of value. Gold has shown that it's got a long-term hedge against the debasement of currencies. And then, in some currencies, gold is at an all-time high at the moment. So that would be our more likely kind of way of investing into that type of theme, but we wouldn't recommend investing into cryptocurrencies.
Okay, so moving on to the last question.
Yeah.
We've obviously had some wars, one in Europe and one in the Middle East more recently. How are you as portfolio managers managing to invest around these global problems?
Yeah, so what the thing with wars is it's very hard to kind of invest around a war per se, and we don't really recommend doing so. And the reason for that is that wars can come and go quite quickly, and often if you're investing into kind of some outcome around a war, you're already too late. The market's already moved. That said, we have had some things in the portfolio that should provide some ballast. So over the last few years, we've been adding shorter duration bonds, and they fared quite well. We also have some gold in the portfolio via some of our alternative managers. So that did well in the breakout of the war. That had an immediate kind of spike. But also we do have some alternative assets in the portfolio. So things like Ruffer Diversified Return, things like Co-Investors Diversified Real Assets, they have exposure to energy assets. So when you had the outset of the war in Ukraine, and then more latterly the kind of terrible events that we saw in Israel, you saw that energy prices had a spike. And so having some assets that have exposure to energy and commodity prices is quite beneficial in that type of outcome. Actually, since then, energy prices continue to slide. You've got oil today is around $75 to $80 a barrel. So it's fallen since the outset of the war, and that's why we recommend not making too many short-term changes around that. But our focus really, rightly or wrongly, is on the bigger picture, kind of global events like global economic growth, the growth in China, growth in US, inflation in those parts of the world, rather than trying to trade around macroeconomic events like what's going on in Israel or Ukraine. And talking about geopolitics, the much bigger question to our mind is the US-China relationship. You had Xi Jinping in the US last year or last week or the week before that. And you've also got the general election in the US next year, which will tell us a huge amount about the relationship between the US and China in geopolitics.
Yeah, absolutely. Well, thank you for that. That was
Anytime.
Well answered as usual.
Thank you.
I mean, the reason we chose you to run the portfolios was pretty much that you don't become overexposed to rhetoric, and you don't run off with the money in different directions. You are steady and long-term investors. So
definitely.
We thank you for what you've done so far.
Anytime.
And continue to make some money, please.
Thanks, Andy. Anytime.
Right.
Cheers.
Thank you.
Thank you.